Hi guys, thank you for joining my channel today. So today I want to talk about investing in the stock market. I know for many of us, including myself, when I think about investing in stocks and shares, I'm not filled with pleasant thoughts. And the thing is, it's not because that I've had exposure in the stock market where I've lost a lot of money, but it's more to do with what I've heard. Whether or not it's through the media, such as watching a movie or a news clipping, my issue with investing in stocks and share was not because of my own experience. And as I look into it and see that investing in stocks and share is a way to help grow your wealth. And if we look at most pension schemes are invested to some degree in stocks and shares. A lot of wealthy people they invest in stock and shares. So today I wanted to, you know, discuss what the stock market is about. So what's the stock market? So the stock market is essentially a marketplace where people can buy and sell stocks and shares and exchange traded funds, ETFs, in a company with the hope that it will grow in the future. Let's get a few definitions of key terminology that will be used when we talk about the stock markets. So I'm just going to look at stocks, funds, bonds, and ETFs. So we just get a good understanding of what those are, because I'll be using those terminology. So stocks represents share of ownership within a company. So companies normally sell stocks when they want to raise money to develop their business. A fund is made up of a number of companies' shares. So you can have a large amount of companies within a fund. So you get to be investing in a wide range of businesses. An example of a fund is the S&P 500. This fund contains the biggest and best companies that operate in the US. So if you were to invest in that fund, you will be investing in a share of those 500 companies. ETFs consist of a mixture of shares and bonds which track the stock market. Example of this would be the FTSE 100. And typically index funds are a lot cheaper than normal funds. Bonds are investment securities where a borrower lends money to a company or a government for a set period of time, and during that period of time they would get interest on the money that they lend. When the period for the bond is matured, the investor would get back their money. Bonds tend to normally not give as high a return as stocks. A key thing to bear in mind when investing in the stock market is that supply and demand drives the price of shares and therefore funds and ETFs. If we have more people selling the same stock, then the price for that stock will go down. Conversely, if you have more people buying a type of stock, then the prices for that stock goes up. And you see where maybe for a certain company, say they they had some bad media or which eventually affected their business, and then the shareholders, they decided, they're going to get rid of their stocks, and then you start seeing the price plummeting because more people are, trying to offload their share. So how can you make money from investing in the stock market? Well, you can do it in two ways. One, when a company that you've bought into, so you've bought some stocks in, when they grow, what tends to happen is that the price, the value of their stocks normally increases. So you can then choose to sell your stock at a profit. The second way of making money is through earning dividends. Now, some companies offer dividends to their shareholders. So, if you buy a stock within a company, that means you have a share in that company. So, you would be offered the same rights as a shareholder, right? And therefore, when they decide to distribute their dividends to from their profit, you would be able to benefit from that. Oftentimes, the dividends are distributed every quarter, but some companies might have it a little bit different. Let's look at 4 things that you do need to know about investing in the stock market. 1, as with any investment, returns are not guaranteed. So you may lose some of the money you put in or all of it. Secondly, you will need to be committed for the long term. Studies have shown that most successful investment tend to occur over the long term. And for that reason, it's advised that if you're going to invest in the stock market, you should be committing 10 years and above to let compound interest and time help your money to work for you, so that when the stock market goes up and down, which is my third thing, the stock market is very volatile, and therefore you do need to allow time for your investment to, ride the storms, ride the ups and downs, and bring you profit. The fourth thing is, if you do invest in the stock market and you only invest in one stock, in one company, there is a chance that you will lose money if that company does poorly. And again, in order to mitigate those sort of things, you would consider diversifying your portfolio. So if you are a stock person and you're not interested in funds, you can select the companies that you want to invest, but select several companies and invest in those stocks in those several companies. Alternatively, you can invest in funds. And as I mentioned, the S&P 500, with that fund, you are investing in 500 top companies within the US. There are other funds out there that invest in thousands of companies. Again, it's you're diversifying and you're trying to mitigate losses. At the same time, you're trying to grow your money. Anyway, guys, thank you for watching, and Thank you for all my subscribers. Thank you. I really appreciate you guys. For those that have yet to subscribe, please go ahead and support me and subscribe. And if there's any topic that you want me to cover, please put it in the comment below and I'll be sure to look at it. So, once again, thank you so much and see you in the next one.